gold's a much better store of value than a 10-year treasury. And I mean, this is a trend that's been going on for some time, but I think it's really starting to accelerate. It really accelerated when the Gulf states started accepting non-dollar currencies for their oil. Because oil is the largest commodity in the world. I mean, in terms of the size of the oil market, it's 20x the size of the gold market. So these people start storing their excess earnings in gold, and that's going to be a lot of demand for gold. And so my belief is that, 2,400 is just jacks for openers. I'm highly confident that within 1 year, gold will be over 2,400, maybe even approaching 3. And I'm pretty confident that in, 4 or 5 years, it's going to be 4,000, 5,000, 6,000 because the trends are just there and they're so powerful.
Gold's remarkable ascent this year, surpassing the S&P 500 by 4%, has been truly impressive. In April, futures and spot prices reached record highs, with gold soaring to $2,413 per ounce and $2,392 per ounce, respectively. Despite a brief retracement, the precious metal swiftly rebounded last week, surging by $60 per ounce to surpass $2,360 on Monday. Notably, just 6 months ago, gold traded around $1,800 per ounce, highlighting its dramatic rise. Lawrence Lepard of Equity Management Associates states that a rising gold price historically signals skepticism about the dollar's stability as investors seek alternatives. Central bank purchases have played a crucial role in driving gold prices, with demand surging to 23% of total demand in the past 2 quarters, up from the decade-long average of 10%. Notable increases in gold reserves by Turkey and China in the first quarter have intensified pressure on the dollar. Recent geopolitical events have exposed vulnerabilities in the dollar-centric financial system. Actions like the U.S. seizing Russian assets and redirecting them to Ukraine have shaken confidence in holding dollar-denominated assets. Additionally, the potential introduction of a new BRICS currency presents uncertainty, but could potentially undermine the dollar's dominance if stabilized. Such a scenario could weaken U.S. sanctions and trigger economic crises, underscoring the importance of alternatives to the dollar. Nations worldwide actively seek such alternatives, with China and Russia trading in their currencies and advocating for de-dollarization. Russia's announcement of nearly complete de-dollarization in trade with China highlights this trend. By reducing reliance on the dollar, nations turn to gold as a hedge against currency devaluation and geopolitical uncertainty. Lawrence asserts that as nations diversify away from the dollar, the demand for gold as a reliable store of value is expected to continue rising, underpinning its role as a critical asset amid evolving global dynamics, predicting gold to reach $6,000 in coming years. We will present clips from Lawrence Lepard's interview with Soar Financially. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
I think gold is sniffing out the monetary debasement that's going to come. I mean, one thing it does is it makes the miners extraordinarily profitable. I mean, I had a lot of miners that frankly were doing just fine at 2,000. I mean, if your ASIC is 1,300 and you're selling your gold for 2,000, you got 700 in margin. That's respectable. That's very respectable. Obviously, if the gold price goes to 2,400 and you add another 400 onto the 700, wow, that's great. Now your ASIC's going up as well because there's inflation and all the inputs. But the point is that, it makes the gold mining business a whole lot better. The spreads get much, much wider. Marginal deposits become more economic. Good deposits, just throw off enormous cash. So it does all of that. In terms of, it sends a signal to the policymakers and to the holders of the dollar and others that, the dollar is not necessarily such a good store of value. I mean, we haven't really touched at all on the BRICS and the way that, the U.S. seizing those Russian assets and then giving them to Ukraine has really created what I think is an enormous monetary shift. And that is, what I call the process of de-dollarization. As you and everyone else knows, the dollar is and was the world's reserve currency and was really the basis of all trade. The petrodollar that Kissinger established way back when. And what you're seeing now is all these countries are realizing that their assets can be seized and the U.S. fiscal condition is very, very bad. And so you're actually starting to see, major countries buying oil in non-dollar currencies. And you're seeing the Gulf states accept them. And then, then they accept, so China buys oil from the Gulf states and they pay with yuan, renminbi. And then of course the Gulf states think, well, if I need something, I'll go to China, and rather than buy those pumps from Halliburton in the United States, maybe there's a China pump maker that'll sell them to me, and I'll just use the yuan to buy those. But if I have too much yuan, you know what? I can just easily swap it out for gold in the Shanghai Gold Exchange. And this is something that Luke Gromen has been kind of all over and talking about. And I think that's another piece of the demand for gold, and the reason why, gold is starting to perform so well is that, nation states, not just people. I mean, you and I might say, hey, there's inflation, we got to buy gold, and in the U.S. that's not happening. Actually, the U.S. GLD, the ownership's going down, but nation states are saying, hey, we used to hold treasury bonds and not worry about it. Hey, we used to hold dollar reserves and not worry about it. Well, two things. One, we've seen the treasury bonds starting to really not do well and jack out in price. Two, we've seen the U.S. fiscal situation get really bad. And three, we've seen the U.S. say, if we don't like what you do, we're going to grab your bonds. And I think those three things are very powerful catalysts for other countries to say, when I end up having a surplus on whatever it is I export, maybe I won't store it in dollars. I'll just, I'll either use it with whoever, whoever bought it from me, I'll go buy their goods. But if they don't have anything I want to buy, I'll just put it in gold. Gold's a much better store of value than a 10-year treasury. And I mean, this is a trend that's been going on for some time, but I think it's really starting to accelerate. It really accelerated when the Gulf states started accepting non-dollar currencies for their oil. Because oil is the largest commodity in the world. I mean, in terms of the size of the oil market, it's 20x the size of the gold market. So, if these people start storing their excess earnings in gold, that's going to be a lot of demand for gold. And so my belief is that, 2,400 is just jacks for openers. I mean, as you and I were talking about before we got on the phone on this recording, could we check back to 2070? Absolutely. Kind of maybe even expect it. I think it would be an enormous gift if it happened. No guarantee it will happen, but it could. I don't care. I mean, I'm always investing with a 1 to 5 year view, and I'm highly confident that within 1 year, gold will be over 2,400, maybe even approaching 3. And I'm pretty confident that in, 4 or 5 years, it's going to be 4,000, 5,000, 6,000.
The Federal Reserve has been battling inflation for over 2 years, raising interest rates and pulling liquidity from markets to cool the economy. Americans last month braced for generally higher inflation pressures over the next few years and accelerating home price increases, according to a report released on Monday by the Federal Reserve Bank of New York. The bank said in its latest survey of consumer expectations that respondents project inflation a year from now at 3.3% from March's 3%, while inflation 3 years from now is seen moderating to an expected 2.8% rise from the prior month's 2.9%. 5-year ahead inflation was seen at 2.8% versus March's 2.6%. Lawrence highlights that inflation tends to operate in cycles, with periods of escalation followed by attempts at containment, only to see another wave of inflation emerge. This cycle is perpetuated by a feedback loop, wherein workers demand higher wages to offset rising costs, leading to further price hikes. Breaking this cycle becomes increasingly difficult as inflationary psychology becomes ingrained in the economy.
Inflation is clearly embedded. It's been let out of the bottle. It's very hard to get back in the bottle. History has shown that the 70s, the 40s, or other periods of time, the 20s. The growth is kind of punk at best. And to be honest with you, all these numbers are very suspect. I mean, the growth, the inflation, all of it. And I think as a practical matter, things are worse than the government's reporting it. I mean, the government has every incentive possible to try and lie and gloss over the problems. And so they do, because they want to remain in power. And, those of us who are out, shopping in the supermarkets, we know, you can see it. And, get your auto insurance bill, get your house insurance bill. I mean, those are recent ones I've seen. They're just huge increases. So yeah, it's, we've got stagflation in my opinion. And sadly, it's probably likely to get worse. I mean, I think that's where, everyone's been made aware that inflation is a problem, right? I mean, it's kind of hard to live in this world. I mean, pre-2020, I mean, inflation really wasn't on the average person's radar screen. I mean, we'd had a 40 kind of deflationary years, and it had never really been a serious inflation problem. Well, we took the headline rate up to 9%. That went away. And so now everybody is aware that inflation is an issue. I think what's going on is we've got a lot of people hoping and praying that it's going to go down and return to tamer levels. While it's certainly come off the boil, I mean, all the money printing, got absorbed, and we haven't been printing as much money recently. And so the 9% headline has come down into the threes. I don't think we're going to make it to the twos, and I could easily see the threes being the bottom, and we start going higher, on the next upcycle. And that's the way these things tend to happen. I mean, in the 70s, you had 3 waves of inflation. You'd have a wave and it'd back off, and they tighten and try and control it. And then you get another wave as it gets worse. And what happens, of course, is that as that psychology gets embedded, this is why it's so difficult to get rid of it. Because, a worker says, hey, everything I'm buying, I can't live on this wage. And the economy is, the unemployment is relatively low. And so workers do kind of have quote unquote wage pricing power, and they're able to demand more from companies because everything they're buying costs more. And so, you get into a spiral of higher costs, higher wages. And then of course the company has to pay a higher wage, so they want to charge a higher product price for their service or product. So, it's a problem. It's a real problem. And, unfortunately the Volcker solution, which was applied in 79 and 80, is not available because too much debt is out there. If we did that, the whole world would go bankrupt overnight. So it's really, the Fed has really got themselves in a box.
The BRICS Alliance's concerted efforts towards de-dollarization and the endorsement of gold as a stable store of value indicate a significant shift in the global economic and geopolitical arena. Led by Russia and China, these endeavors aim to diversify value holdings away from the US dollar, underscoring the ongoing evolution of the international financial landscape. While the sustainability of this trend remains to be seen, the increasing prominence of gold as a safe haven asset and its continued price appreciation are undeniable factors shaping the future of global finance. Share your thoughts on Lawrence's prediction in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.